one. You wanna move the rest? It's the register. Okay. So on the first of,
Your funds was on your account?
yes.
Okay.
For the first of April, they got the second attempt. I can send you the exam. Yeah, cause I have to travel.
All right.
But I'm coming back from somewhere on that day,
Okay,
so, I will
That's-
send you
that's-
to,
that's that day.
yeah,
Okay,
in 2 weeks.
all right, no
Okay.
problem.
Morning. So I have the homework there for chapter 19, because I didn't do anything for that, and also, what we're gonna do today, chapter 20. On April 1st, can be the second midterm. Um. Let me put it on that. No, the second midterm cover 19. Yeah. Okay, so chapter. So last week we did. Excuse me. Last week we did chapter 19, which was on tax. And as I said, April 1st, we're gonna have the second midterm, so they're gonna be from. It'll be 18, 19, and 20. And I'm gonna focus more on a lot of theory. I'm gonna probably have one question, they're gonna be small, because most of this homework that I assign are the brief exercises. And the questions which are more theory in your textbook, so they focus on definitions, knowing the terms. That can help you with multiple choice, so the same thing, you have questions, so you know the terminology. The brief exercises are small, like calculate the tax, whatever it is, for this chapter, and for chapter 20 is on pension. Same thing applies, right? So chapter 18, just as a reminder, was revenue recognition, so that was a lot of theory and knowing when to recognize revenue. So today we're gonna focus on pension and post-retirement benefits. So it is important. When we talk about pension and why we're talking about it for accounting purposes, to remember that whatever activities the entity is doing, you have to think about how do we account for it. So pensions, chapter. So normally we know that a pension plan is an arrangement where the employer provides benefits to the employee. At retirement. So You work, so you know that you are probably in a pension plan. Nowadays, it's not as, it's very different than in the past. So I know some companies, it would be an option, it's not required that you have to be in a pension plan. But in the past, everyone was in a pension plan, that's why people wanted to work, because they wanted to know at the end of the day, when they finish, if they stay at the company, until that age, they will be taken care of afterward. Right? So that doesn't really exist like that a lot anymore, because a lot of companies are not in business long to do that, right? That's a reality, and a lot of, and so for accounting, we have two types of plans that you'll normally see. Defined contribution. And defined benefit. So just a question, do you, which ones do you have at your company? Your companies? So why do you think so? I'll tell you how much. Mhm. They contribute. They could do that for both. Yeah. I've made the features of it. I'll tell you the type of them. The employee pays, a portion, and the company pays a maximum. Matching. Portion for that. There is manually determined the employee that's there. Okay. There is not a defined time when you can get it, because they come for the time and you still receive whatever it is that you contributed. Yeah. Okay. So this used to be the standard. Right, and people trying to get away from that. That's what the government has. Very old companies had it, and they trying to get everybody out of it and put them here. Because what these plans normally do is define benefit, is say that we're gonna give you benefits. So we normally look at your average salary for certain years service, say, the one I'm most familiar comes to me was last place I was working. And so they took like your 3 most profitable years, they averaged them out, and they guaranteed that they will pay you 80% of that upon retirement until you die. Okay? They are 3 most profitable. No, yours. So profitable means that your highest salary. So if you might have started as a teller, right? But you are a vice president, so they're not gonna take the vice president pay, they're gonna take the average 3 years while you were VP, right? And then they can pay you, I think it's like 80% of that until you die. So nobody will do that anymore. So that's what it is, because that's what the government is. That's what government is. That's why people in government, because they know that they will get not their full pay what they got, but a percentage until they die, right? And upon their death, their beneficiary will get that for 1 year. Most plans do it like that. So your beneficiary, I didn't get a year, it could vary depending on the plans identified, right? So the employee, like this, right? Now, this one, how that works is, and that's what everyone moving to, is that you contribute, they contribute, and whenever you retire, you just get whatever's there. So no guarantee pay, people spend all of it in one spot, whatever it is, that's it. So they could do it where you get it back over a period, right? And it'd be like an annuity, so you'll get a certain amount. But basically, you only get what you pay in, and if you vested, you get this. If you're not vested, you don't get this. So accounting. If I'm the accountant in the room, I like this one, I don't like this one. Right? So you hear them and then you was talking about NIB. Reason they talking about NIB, because NIB is this one. Right? And the challenge is that those plans, one of the things why they made sense in the day when they were doing it, it was that, and this for companies as well. NIB is working on this principle that you will have new people come in to pay the old people. Right? And that the country itself will be profitable, because if the country is profitable, everyone will be paying at the maximum. High unemployment doesn't help a plan like that, because you paying a benefit to people who contributed. And if you start having fewer people join, or fewer at the higher levels, then you have a problem in terms of what you have. So that's where they get into words like you'll hear them talk about funding. So this is one of the terms. So funding. So this is where the employer, these makes payments. And they want to ensure adequate funds are available. So they got to make sure that they put in enough money, so adequate funds are available. So with these two plans, they could be non-contributory, or it could be contributory. So employer bears full costs. And this is shared. Okay, employee. So is some terminology. The other thing, and this applies because we can focus on this one here. The rest of the chapter that they talk about is based on this. This has the most accounting. So when we line these two up together, and I like tables, so if I line these two up together, so I call this DC and DB. So I have so DB is complex. This one is simple. In terms of the accounting and considerations. Yeah, you need an actuary. Everyone knows what actuary does in relation to pension. Okay. Actuaries make predictions on life expectancy. They make predictions on, likelihood and probability of certain events happening. So you have, they are normally, in a lot of cases, they are hired by insurance agencies that offer annuities, health plans and all this, because they have to work on the probability that if we insure this whole block of people, how many of them gonna get sick? Right? Because then the insurance company have to set the rates in a way that they have adequate funds to cover you. So that's why you get into situations where they say this benefit is not covered. Because the actuary is doing it based on average rates. So if you're someone who's already susceptible, not even susceptible, but if you have a chronic illness, they're gonna screw up the whole calculation. And so they take you out of it, right? Or they say, we can't cover you. So they also work in the pension space, because what they're predicting is how many people you're gonna have to pay for at the end, right? So how many people are gonna make it way to the end in terms of retirement? People pass away, people leave, also people's salary change, right? You have a lot of variables. And persons who study actuarial science, they normally have degrees in pure and applied math, because there's a lot of calculation and modeling that they do. It's actually very difficult to become an actuary. When I was in university, in the Caribbean, there was only one qualified actuary, and there were only, I think, 5,000 in the world. Fully qualified, because it's a number of exams you have to take. So now, of course, there are more persons. One of the actuaries that is here, who is, I could say he's been in because he went to university with me. Right? He was from another Caribbean country because he married Bahamian. So I think Bahamians, it may be maybe like 3. I don't even know if we have 3. But of course, they get paid a lot of money because it's not a lot of them, and they have multiple jobs. So they advise and they work privately, or they could work for a company. But this is what they do, right? So from an accounting perspective, when you have this type of plan, you need an actuary. And the company normally has to, when they do their audited statements, they have to have a certified actuarial report to say what you provided for is adequate. If it's not adequate, you have to make adjustments. And those adjustments could be punishing, because if they feel that your plan is not adequately funded, you got to put some money in it. And sometimes those swings could cause you to be in a loss position on your balance sheet. Although you were on your income statement, although you were profitable all year, they'll say, hey, you don't have enough in your plan. You need to put like 5 million in it. Then all of a sudden you have a loss. Right? So when I go to companies, if I see this, I say, get rid of that. But if I am the employee, which I was in the case, and they said, we bring in this, and they asked people the question, do you want to stay here or do you want to go here? They actually provided what I call a sweetener to convince people to go here. And so when people ask me, should I go here? They say, don't move. This way you, because this is beneficial as the employee, right? But everyone's circumstances is different. And it's so funny, I advised the board, and we had this company not even in the financial services space, and they have the same thing going on, and everybody moved except one person, and the board could force that person to move. And so I said, well, give them a sweetener, tell them you will pay extra cash, because it's like worth it. Okay. And they actually told us a story that the reason they didn't want to come out of it is because their parent, when they passed away, they had nothing and they didn't have any resources, and it was very personal to them why they don't want to go here. So it's like, wow. So for accounting, again, like I say, this is what you want, but sometimes this is what you have. So we can talk about this a little bit. So the other thing to recognize with pension plans is that companies could self-fund or they could give it to another company, right? So we don't have pension, we don't have pension legislation in the Bahamas. A lot of persons want us to have it because of City Market and Clico. Because what those companies did, because they were self-funded, they were self-funding their pension plans, they took money out of people's plan, and when they collapsed, they got nothing, right? But if you have it regulated and there's legislation and you protect their funds, you can't touch it, and it have to be segregated and all of that. So that's why I say the accounting here is important, especially as well if you're self-funded. So I don't know, your pensions in your company, do they do it or they like with Colleen or someone else?
Well, we have two pension plans. They do one personally for the staff and general,
Okay,
and they fund at 100%.
okay,
And then we also have one with car with it.
okay, okay, okay. Yeah, see, a lot of places move in where they don't do it, and I get bet the one with CG is this. Yeah. Yeah, the one in Canada might be this. Because they're probably tied to, bonus. That's what some companies do this. If they want certain people to join them, they will make this like a benefit. And only offer it to a certain select group. That's how I see this moving. So, when they're self-funded, you have to set aside funds to make sure you have enough money here. As well for here, you need to make sure you're making your contributions on an annual basis. So of course, you realize if you're self-funded, there could be a temptation to say, yeah, on paper, we owe the pension that, but we can use the money somewhere else. It's a temptation, so both plans, there's a move that they, especially locally, we don't have legislation that is good practice that you don't self-fund, but people do it. So here, in terms of accounting, you're not gonna have what we call, you're not gonna know, you'll have no pension asset. And you're gonna have no liability recorded. You're gonna have pension expense. And really that's the amount you pay for pension. Here now, you are gonna have a pension asset. And you're gonna have a liability. And the pension expense. This one in addition, so we stop there for that one, nothing more. Here, we look at a time value of money. So that means those tables where you discount, you say in the future, if I have to pay this person 5,000 every month, I have to discount that to today to say, what is my obligation for that individual? For everyone that is in that category. And every year you have to work out what that discounted. So here we concerned about time value of money because we have to pay things in the future. We also here you tend to find that the employer um, you tend to find that in this one, the employer tends to contribute all of it, right? That's not automatic, but your textbook says that, but that is not necessarily happen all the time in practice. Here, the contribution is normally shared. And of course, it's gonna have a defined vesting period and criteria. So. That's the same for both. All right. So we have DB, DC. And like I said, we can spend our time on this one here. This is where we have a lot of the accounting, a lot of issues that come up. I want to, before I go to the worksheet, I want to talk about some more terminology. So everyone knows what vesting is, right? Okay, so. Yeah. So some terminology is important to know. Vested benefits. So companies need to know what they have to pay in the future and who they're obligated to. You put aside funds for those persons who are vested, you have to pay them. Even if they leave early, you're gonna have to pay them your contribution, right? And so under the defined, and like I said, we under defined benefit, there are three options. So three options exist in terms of measurement. So we gotta measure that future benefit. And we have to put it on our books today because we know we will be obligated to pay it, right? So one option that exists in accounting is vested benefits. Vested benefit obligation. So here. So so under this option, we are looking at benefits for vested employees at current salary. Okay. So here. The second option we have is accumulated benefit obligation. Under this one, we looking at benefits for vested and non-vested employees. At current salary. Okay. So non-vested and vested, here vested current salary. The third option. It's a projected benefit obligation. So here. We looking at benefits. And here is for vested and non-vested. Okay. Employees. But this is our future salaries. Okay. This is the one. Accountants use. So this is the one we use because this makes sense. Because this one at current salary, these two at current salary. First, this one only takes in consideration only vested. This one takes both because people could vest at different points, right? Again, both of these are the current salary, but you gotta pay something in the future. So this one captures everything, including the future timeline, because that's when the benefit will have to be paid. And that's why it makes sense, for you to, think about future consequences for expenses. So, of course, to be able to do that, you need actuary. Right? Because they're gonna look at rates and they're gonna look at mortality and all of that type of thing. They can look at salary, inflation. So the level, salaries are increasing. But I was thinking about it in preparation for this. I'm very curious at that. My friend who does this, how did they deal with COVID? Because that probably shattered all of the stuff that they have because a lot of people passed away. And that's something they could not predict. Like there are things, the events, catastrophic events that they just can't predict. Once, or they say once in a lifetime situation, but this is where we sit from an accounting perspective. So we are now at defined benefit. We know we're gonna look at the future obligation, vested, non-vested employees. So now let's get to our income statement, balance sheet, activity. So the first thing is that we know we're gonna have an expense. We gotta pay this pension cost because we paying for you are employee, we gotta pay the portion that belongs to you. So that's an expense that we pay to match your contribution. So whether you're vested or not, the company is paying that. If you leave before your vesting period, it goes back into the fund. Right? So, or some companies take it out, depending on what type of plan they have, they take it out and they just record it as a gain. Because you left, you were invested, so they save some money right there. So on the income statement. We have pension expense. And in that. We have these following components, so we have service costs. So what do you think those service, what that represents? Well, that is gonna be included in the cost, like, we would put that more on the administration costs to administer a plan. You're gonna have certain expenses, the actuary, the external auditor, whoever it is, to make sure that thing is running, right? If you hire a trustee or insurance company, you have to pay a fee, so they are like administration costs. So the service cost is actually that same present value of, the benefits for service, right? And service being service by the employee. So this is the base of the calculation. So that contribution they make for you is a benefit because they giving that to you for your service, right? You serve the time required. And this is normally based on a formula defined in the plan. So you'll have your plan and it'll say, we pay 5%, or we're gonna pay a flat fee, whatever it is, right? So this is the core of pension expense, because this is what they are contributing to the plan, right? The cost, the service cost, your, the cost to have you sit there, just part of the benefits we owe. So another component is interest. Right, so this interest on the liability. So here, so for the plan, right? You're gonna have a projected. Pension. Obligation. On our books. So. So this amount that you are obligated to pay in pension, it don't just sit there, there's interest attached to that. So whatever interest attached to that, you also have to pay, right? Because that means that whoever, that benefit is for each employee, whatever you owe them for them, there can be interest too, right? So it's just not the flat contribution. Then we have, let's see. Then we also have in this the actual return on plan assets. Okay. So this tends to decrease the pension expense amount. So people contributing to a plan, you don't just have it sitting in cash, you invest in it in different things. So you may be invested in government bonds, you invested in stocks and shares, whatever it is that you invest in, there's gonna be a return. Whatever that return is, it normally is gonna decrease this number because it decrease your obligation in terms of what you have to pay in the future, right? So I don't know if you realize when those government bonds come out, some of the first people to grab them are pension plans. And you'll see like, that same FTX thing that blew up. Some of the biggest losers in that were pension plans. They said the Canadian teachers pension plan had like 100 and something million in it, right? Because they looking for somewhere to put that money, because if you invested well, you could reduce this cost. And then the last component is the amortization. So that. So amortization of prior service costs. So what this is, excuse me. So this is the cost. Of providing retroactive benefits. So this tends to increase the pension expense. So sometimes with plans, they adjust the benefits to the plan, and there may be consequences of that. Like it may increase this number, that's why I'd say it tends to increase your pension expense. So when that happens, like I say, this cost is gonna flow through pension expense. So when you see pension expense, it's really in a defined benefit plan, let me qualify that. In a defined benefit plan, pension expense will have these components. Okay. So. Now we're gonna do a live calculation to see how this all works. So for accountants, there are certain things that we do and calculations or entries that we do, and sometimes we use a worksheet. So for preparation of the actual financial statements, I think the course you did before this one, there'll be the worksheet where you have the trial balance, then you put the adjustments, and then you have to adjust the trial balance. You have that worksheet that goes straight across to get your final calculation. So we tend to have worksheets for different types of transactions that might be complex. So for pension, we have one. Everyone got this right? Okay. I just want to put it up because I can go through an example of one. So. Okay. So normally we have this thing that we call a pension worksheet. Okay. So it has two parts. So one side of it. So one side of it, we have the journal entries. And on the other side, we have the memo record. So. Under the general journal entries. We have 3 elements. So we have the annual pension expense. We have cash. And we have the pension. So this can be an asset. Or it could be a liability. So that can be our entry at the end. So when we finish, we gonna have a journal entry. And our journal entry can be pension expense. We have cash. And then we either gonna have the pension asset. Or we're gonna have a pension liability. Okay? We're not gonna have both, we're gonna have either one. Right? So we doing this worksheet to get these 3 numbers. Okay? On this side, which we call a memo. This is where we focus in on the actual plan. So we have the plan assets. And we have the projected. Benefit obligation. Okay, so we got the assets that we have invested in the plan, because people have been contributing, we buy stocks, bonds, whatever we do. They're the assets are sitting in the plan right now. And then we have the projected obligation benefit. Because this is a memo record, because these 2 should be equal. Okay. They should be equal. So when we do this entry over here. Part of this entry. Gonna make sure these 2 equal. Because this one could change. Right? You see why it could change, right? Every year this could change because someone may leave. Someone may retire. Someone may pass away. So this can change. But these 2 have to be kept in balance. And that adjustment to keep it in balance is what come in here, right? Gonna end up in this pension expense number, gonna swing on net income, positive or negative. And it can be the adjustment that have to go in terms of our pension asset or our pension liability, right? And this is a big deal if you have those plans. This was 2013. What was I doing? Left there 2018. I think like 2015, when I succumbed up bank, and they have it in their reported numbers. They had a significant adjustment to their plan that was almost 2 million. And it was like everybody sitting down trying to see how the actuary, like how y'all come to this number, and you could do nothing about it. And that's just, that hit your line just like that. And they moved, I think, was it that year? I think that year is when they started moving everybody over and say, we can't do this. The same make no sense. And so some people are still in they have a combination there, but that's why a lot of companies moving away from that. And they'll have, like, that'll be in their notes, to their financial statements, the plans that they have, they'll have all these details. So we got these three. Columns. Okay. And these the items we can deal with. So I can have a little example here. To illustrate how we're gonna use this worksheet, and normally at this stage, this is what you will have. So we get our plan asset. First of January. 2020. 450,000. Okay. So this projected benefit obligation. So that's this one, sorry. And this is at first January 2020. 450,000. So you see the starting position, they equal. Okay. So the annual service cost 2020 is 27,000. Then we have the settlement rate. %. We have annual return. On plan assets. 2020. Is 30,000. Contributions. Funding. Again, for 2020. Is 32,000. And then benefits. Paid to retirees in 2020. 17,000. Okay, so they give us the plan assets. The projected benefit obligation at the beginning of the year. The annual service cost for 2020, that's 27,000. They give us the settlement rate. The annual return on plan assets 2020, so this is what they got from investing. This is the return they got. This is the contribution funding. So this is what was contributed, 32,000, and then these the benefits paid to retirees. Okay. So now we can put it in this plan. So the first thing we do with our worksheet. First thing we enter is our opening balance. So our balance at 1/1/20. Right? We don't have anything here. The balance goes here, so we're gonna have. $450,000. And this a credit. And 450,000. And that's a debit. Right? So we think about our balance sheet, we have the part that's invested, that's the asset. And then in the liability portion, this is what we owe in terms of paying those benefits out, so they're both equal. So now to calculate these three columns and make sure at the end we balance and come to this entry. The first thing we deal with is the service cost. So they gave us the annual service cost because we dealt with that one, we dealt with that. So so the service costs. So we know from what we just, when I gave the components, we know service cost goes in the pension expense. So the 27,000 gotta go here. Cause that is where service costs go, and that'll be a debit, right? The next thing they tell us is the settlement rate is 2020, so that's the interest that they're telling us. So this is another component of pension expense. So the interest cost. So they just give us the rate, so we have to calculate it, so we have to take the value that we have, 450 at the beginning of the year, we times it by 7%, because it's annualized. So 7%, but 7%, and you should get 39,500. Okay. 31, sorry, 31, yeah, 31,500. So that was the second component I said, a pension expense. So we did the rate. So the next component is the annual return. Okay. And we know the annual return comes from what we invested, and that should decrease our pension expense. Since we invested it, we get some money. So that should increase. So that's a credit to our. So here we have three components: annual return, interest cost, service cost. Now that fourth component is not gonna come up in this example. It's another one I'm gonna do, and you're gonna have that element. So here, so we have the annual, so now let's get the contributions and benefits paid. So D, we have contributions. So that's the contributions here of 32,000. So that'll go here, because that's how much we paid out in cash. So that'll be a credit to cash. And the other side will be I forgot to do the side. 32,000. Right? So this will be debit. The credit debit. This is a debit service cost. So this will be here. And 30,000. Right. So let me go over that again. So we started here. We have service costs of 27,000. That's gonna impact the obligation. We have interest costs, right? 31,500. So that is related to the obligation, right? Then we have annual return on the plan assets. So that's what we made. So we have 30,000, that's gonna reduce the pension costs. And it's gonna increase the value of the plan assets, right? Then we have contributions. So we pay that out in cash. And then these plan assets will be reduced. I have to run, that's right. Debit. No, sorry, contributions you added to it. I was thinking this was the last one here. Contributions is what we added to, but we paid, right? And it went into the assets, so an increased amount that we now have in assets, so that's the contributions for the year. And then the last one here is the benefits paid, so this is where it reduces it. So this is where some people retired and you gotta pay the benefits. And that amount is 17,000. Right, and that's the credit. And on this side, debit. Okay, so that doesn't impact pension expense. It doesn't impact this side here, the cash or pension liabilities coming straight out the pension. Right? Because that's what you're setting up the pension for, that you have the cash in the assets to take out, and then you reduce the obligation because now they out. So you don't need to carry a balance for them anymore. All right. So here is where we draw a line. Okay. And this is where we get our journal entry amounts. So this is the journal entry 2020. So here, when we add up all of that, so there's 2 debits and 1 credit, we should have 28,500 debit. Here we got 32 credit. And the difference between this column and this column is what is gonna be either our pension asset or pension liability. So this is a debit. So what is that? That'd be a pension. Which one? Oh, this should be credit. Sorry. Pension liability. Notice debit. This debit. We have a balance entry. So this debit. Right? So when we do our entry now, we could populate this piece here. We got pension expense. 28,500. We have cash. 32. And then this difference here, 35. Okay. Now, on this side, we also have to look at this. So the total here, we can have 495,123, that's debit. Okay. On this side, we have 491,500. And this is the credit. And the difference will be the same 35. Okay. So okay, so the actual obligation, we want these two again to be balanced. So we have here debit 495, we have 491,500. We need this amount to be here, right? In terms of the pension obligation, when this entry goes in, this pension asset, when that goes in, what should happen? This amount should increase to the 495, right? So what this worksheet allows us to do is determine the pension expense, the amount if that's gonna go to cash, and then whether it's gonna be a pension asset or a pension liability. So at the level that you're doing this, these are the pieces will, that you'll have and you will be given, so you know, okay, where do they line up? So what are the components of pension expense? Where do I put contributions and benefits paid? And then once I add it up, how does it all balance out? Now, remember I said there was a fourth component of, pension expense, and that was the prior service costs. So we can do one with prior service costs in it. Everyone got this one? Okay. So a little bit better. So.
So the journal entry pension liability, that was an effect that I was supposed to point out.
No, because why I put it like that is it could be an asset or it could be a liability. But if you set up an entry like that, it can fall in either one. The entry always, the key is the entry always has to be balanced. So if you know your entry, to balance the entry, it can have whatever you need to do, that's what it should be, a debit or credit. So, yeah. What she. Sales for this one. Mhm. We got the present value of prior service benefit. Granted. 1st of January 21. And that's 42,000. Annual service costs. 21. 28,000. So we can bring over what we have from the last question, 3,500. Right, so it's the items. So this the forward, so this the balance. 2020. So in our last question was end of 2020, so now we in 2021. So this is what we open with. So that was the debit. 491500 credit. 49512 debit. Okay, so that's where we starting off. So we got these prior service costs granted, we have annual service costs in 2021 of 28,000. We also have settlement rate again. %7, so that didn't change. It's 2021. Then we have actual return. On plan assets. $31,000. Contributions and funding. Benefits paid. And amortization. From prior. Service costs. So they give us this information. And we're gonna do the same thing. Except we now have this prior service cost element. Let me put the entry. Pension expense. Other comprehensive. PSC is prior service cost. Yeah, cash. And then we got the pension. Liability. So if it's here, it can be a liability. If it's here, it's the asset. So let's go down these numbers. Same as we did before. So we have our opening balance. And the new one we have is present value of prior service benefits granted the 1st of January 21, right? So this is something we also add in our opening, so this is A. We could take that off. And so here we put the space right there. A, so this is prior service cost. Prior service cost. And they tell us 42,000, so you drop that here. And that's the debit, because that's the cost to us. And remember, it's gonna be a portion that's amortized. So what happens is that if you go back and you say we have to do some adjustments to our plan and it's set up as prior service costs, then you don't take this whole thing to expense, you amortize it over a period, right? We're not getting into the amortization and all that. They gave us the amortized amount So this is the opening balance, so you're gonna amortize this, reduce it every year until it's gone. Right, so that's why you see an opening balance. Right, because at the bottom, they gave us the amortization amount. And this amortization amount is what goes into pension expense. But we're gonna walk that through. So we open with this prior service cost. So now let's get to what we just did. So we have all these amounts that we paid. So the next one is our annual service costs. So we know that's 28,000. So that goes into pension expense. Right, just like the last one. Then we have our settlement rate, so we know we got interest. Interest costs. And now when we work out our interest costs, right? Sorry?
Is it on the 495?
No, we're gonna add, when we add the interest cost, we're gonna add the amount 495 plus this 42,000. Right? So I'm gonna give you the interest cost in this one, because I don't want you to focus on how to calculate it. I will not ask you to calculate anything, I'll give it to you. Got this, so interest cost. 37,345. Okay. So I'll just put the number here, so we don't have to get into all of that. Interest. All right, so again, that's in pension expense, that's a component again. The next one is the annual return. Okay, so that was 31,000. So that's a credit, these are debits. I didn't do the other side, I should have done the other side, so. So when we have prior service costs. The other side of this, because anything on this side. Has another side, has the other side is gonna be either pension, obligation, or plan assets, right? So we added this is a new one, prior service costs, so this is a debit. So the credit side to this is on the pension obligation. So our opening balance here. Yeah. 523. Got it. Okay, so they the opening balances, so this is a debit, so this is a credit here. So we have the service costs, and just as we did the last time, we put the service cost here. In the obligation. Right, so that's credit, this is debit, so this is credit. Interest cost, just like we did the last time, we put the interest cost here, 37,345. Credit, debit, right? The annual return on the plan, so this is how much we made off the asset, 31,000, so it's a credit here. And this is what we made on the plan, so we have to put it here, 31,000. Right, it's a debit because it increased the value because we made that money on it. So next one is contribution of funding. So contributions. So here we have 29,000. So we paid that. So that's a credit because we paid that in cash. And then we have. 29,000 because we contributed that to the plan. So they new contributions. So they had to be paid in cash and contributed to the plan. Benefits. So we had that in the last example. So benefits. So benefits reduce both sides. So here benefits were 24,000. Debit, 24,000. Credit. We're taking it out of the plan, our obligation for that person, and we reducing the assets because we paid those benefits up, right? Okay, so let's get the. So we have our 29. So one more entry. And this amortization of prior service costs. So this amount is gonna be amortized. Remember I said this is a part of pension expense. So PSC. So they told us it's 17.5, so we know it's gonna be part of this amortization cost there. And it's gonna increase our pension expense. So we have it there. And then this part will be this debit, this is a credit here. So this should reduce the amount, the balance brought forward. Okay, so all these columns now, we have accounted for all the different entries. So we have prior service costs, so we have all the opening balances, prior service costs, service costs, interest expense, the annual return, the contributions, the benefits paid out, and then this amortization. Okay. So what we have will be our journal entry. Put this a little lower. So we total this to get our journal entry. All right, so we have the annual pension expense amount. Put it as pension expense. So we total all of these, we should have 51,845. Okay. You got cash at 29,000. We have this prior service cost amount that's now amortized, so part went in pension expense and the other part has to reduce this account here. So we got the 17,500 credit. So let me leave that for right now. Then we have our pension. But our total, that's total. Then we have. Okay, you got a 17, oh, did that wrong. It should be these two items net. So that's 24,500 debit. Okay. So now our pension liability amount. So we have 24,500 debit. And then we take this amount here. We have 4224. Then on this one, we have. The total of these should be 574. 845. And then on this one, 531. Plus debit. Credit. So the difference between these two should be our pension asset or liability credit, which should be 43,845. Okay. So again, when we go to our entry, we have the pension expense, the cash, we have a new component that we also have here. We have our other comprehensive income. Plus power service costs. So we're gonna have a 24,500. And then our pension. Liability. 43,845. So just going back over this. So we have our pension expense, this is the first column. Cash, 29,000. All right. Then we have this prior service costs, this other comprehensive income. Prior service costs, so we have this 24,500. And then our pension liability amount, which is the difference between these two amounts here. We have the total projected benefit obligation and the plan assets. So this is the amount that we have to adjust so that these two are balanced, right? So the whole worksheet is to get us to here. And this is actually what is done in real life. Because I have seen them have to do these schedules and it's insane. So, any questions on that? That's a lot.
What does that say, other comprehensive?
Yeah, other comprehensive income. So that's the section is gonna be on the income statement. So on the income statement, you'll have your operational income. And then after you work out your operational income, there are other items, right? Because this isn't really operational, right? So you wouldn't put that in the operational section. So that's why it's limited. So like I said, the questions I gave you for homework, focus on the theory. There are the brief exercises, exercise 4 is one like this, exactly like this, and you just put the numbers in, right? So the most important thing for this is knowing the components on the worksheet, right? So that you know if I have pension expense, I can have up to 4 components: service costs, interest, the annual return, and past service costs. Not necessarily you'll have past service costs in each example, but you definitely these 3, right? You'll always have contributions and benefits that you have to pay, and then knowing how it impacts these 2 columns, because these 2 should always be balanced. All right, so I'm gonna leave it there for today. So I'm gonna post this and thing before I leave in the Google Classroom, so everyone has it. Any other questions? So next class, we will be doing chapter 21 leases. So for the midterm, it's just 18 to 20. I'm not doing leases in this section. Put that in the next one. Make it time, because I give this.